Hello traders, this is the weekly market update podcast from the PPI broker. We start from the economics as usual and from the United States. Last week, the data out of the US left market participants guessing about the amount of easing in the coming FOMC session. On one hand, the CPI report was harder than expected, printing a 0.3% increase in the core rate and a 0.33% jump in the supercore inflation, which was the highest since April. On the other hand, the budget deficit of the federal government just rose to its highest levels in 2 years, and also the interest payments exceeded the $1 trillion mark for the first time in history. Also, the PPI report and unemployment claims were soft and reduced the concerns about sticky inflation. Combination of the cooling job market, rising deficits, and still unsolved geopolitical tensions caused the gold prices to break out of its recent range box and register another all-time high. Elsewhere in the world, we start from the United Kingdom. Even though we have a rather bleak GDP report on Wednesday, which showed no growth, but it seems that the job market in the United Kingdom is showing resilience in the face of mounting pressure. The British newly unemployed persons rose by just 23.7 thousand, well below the 95.5 thousand the market expected, and thus the unemployment rate actually decreased to 4.1%. Even though the wage growth was below market forecasts, the very fact that we are witnessing a still growing workforce argues well for a less dovish BOE for the coming week. And this helped the sterling to regain some lost ground against the greenback last week. In the Eurozone, the European Central Bank lowered its benchmark interest rate on Thursday according to market expectations, and for the second time in recent months. The ECB staff also lowered their forecast for the overall growth of the European economy, but kept their inflation forecasts unchanged. Christine Lagarde, the ECB chief, pointed out in the ensuing press conference that the direction of the interest rate path is pretty clear, hinting at further rate cuts down the road. Nevertheless, the common currency managed to retrace a good portion of its recent decline against the dollar, as the general mood for the greenback soared on Thursday after a higher than expected budget deficit. In China, the data out of the world's second largest economy continues to be worrying. After reporting lower than expected inflation numbers on Monday, the industrial production data also showed that the Chinese manufacturing sector is not experiencing a boom, as the production rose by just 4.5% year-on-year in August, the least since March and well below market expectations. Also, the house prices in China continue their downward path. China's new home prices declined by 5.3% year-on-year in August, after a 4.9% fall in the previous month. It was the 14th straight month of decreases and the steepest pace since May 2015. Monthly, new home prices dropped by 0.7% for the fourth straight month in August, remaining at its fastest fall since October of 2014. In the geopolitics arena, in the Middle East, the Houthis of Yemen just fired a ballistic missile towards the Israeli capital at Tel Aviv, which caused minor destruction as the missile was seemingly blown in the air. Also, it is speculated that the Israeli army will soon begin a major ground operation against Hezbollah in coming weeks, which will be a considerable risk for the markets, especially oil. In Ukraine, the Russians have begun a massive counterattack against the Ukrainian army in the Kursk Oblast. The anti-NATO rhetoric from the Russian officials have increased in recent days, as the Western leaders are discussing publicly the option to allow Ukraine to use NATO-made missiles to hit targets deep in the Russian territory. For the next week, we will have some important data out of the US, the most important of which will be the FOMC session, and also we'll have the retail sales report and unemployment claims report. In Japan, we will have the BOJ rate decision. In the UK, we will have the central bank, the Bank of England, and the CPI reports. For the Canada, we will have the CPI and retail sales report, and in Australia, we'll read the employment report. Good luck.